accountants, this is Mrs. Lamphere, and this video is going to be over section 5 of our unit 4, and this section is over the income statement. So we briefly talked about the income statement as a part of the accounting worksheet that we worked on in the last section, and this is going to look at the income statement as a separate financial statement for a sole proprietorship. So we've talked about, in the first unit, we talked about the different types of business enterprises and how they're either a sole proprietorship, a partnership, or a corporation. And the sole proprietorship is a form of business organization common to small retail stores, farms, service businesses. If you remember, sole proprietorship is when there is one owner that makes all the business decisions. They are in charge of managing the finances and making sure that their business is running smoothly. So there's only one individual in charge of that. And in this section, we're going to talk about the preparation of financial statements for the sole proprietorship. So before, the accounting worksheet that we worked on, that was more for a partnership or a larger business. Now we're going to look at specifically at a sole proprietorship and preparing the financial statements for that. And we're going to go over some key terms and make sure you are ready for the quiz for this section. In this video, we're going to talk about the purpose of the income statement. We will learn how to prepare an income statement. We will explain the purpose of a statement of changes in owner's equity and also define other accounting terms that are used in this chapter. So these are the terms we're going to be looking at in this section: sole proprietorship, income statement, financial statement, revenue, expense, net income, net loss, balance sheet, customers, and creditors. And so we've already dealt with a lot of these terms before, but they're going to be used again in this section. All right, so sole proprietorship. This is an unincorporated or not registered business owned by one person. They act as the manager, they make the business decisions, so on and so forth. We've talked about this before. So you can define a sole proprietorship from either an accounting perspective or a legal perspective. So we've mentioned before, in the accounting perspective, the business and the owner are considered two separate entities. So when we talk about the initial investment into the business that the owner makes, a lot of you are like, well, cash is decreasing because he's taking the cash and putting it into the business. But this is where that comes into play. So because they are two separate entities, we are not looking at his personal cash. We are only looking at the cash of the business and the value of the business. So that's why in that initial investment, both cash and owner's equity are increasing, because they are two separate entities. That's the accounting perspective. Now, from a legal perspective, they are not considered two separate entities, meaning that if the business goes under and has debts, then the owner is responsible to cover those business debts. So again, accounting perspective, they are separate entities. Legal perspective, they are not considered separate, so the owner is liable or has to pay all the debts of the business should the business go under. So some advantages of sole proprietorship include quick decision making. You're the only one making decisions, so you have more control over those decisions. And this really allows you to build a close relationship with your customers and employees. You don't have to worry about having a whole bunch of managers and like a line of oh gosh, what do I want to say? A line of managers to get to the owner, because you're the owner, so you can interact with customers and employees as much as you'd like. Disadvantages: unlimited liability. So again, that's where we're saying, so if the business incurs a lot of debt and gets into trouble, you personally are financially responsible for that business. Limited capital, meaning the capital resources or the money coming into the business to get it started is coming from you. So there's not multiple investors, it's just your money going into the business. Decisions, consequences concentrated on one individual, so all the risk comes to you. All the decision making comes to you, all the risk relies on you, so it can be a little more stressful and, oops, I'm going to skip that page. Okay, financial statements of a sole proprietorship. So this is what I said we're focusing on in this section. So when it comes to a sole proprietorship, there are different accounting reports prepared, and the principal financial statements of a sole proprietorship include the income statement, the balance sheet, owner's equity statement, and the statement of cash flow. So we've dealt with income statement and the balance sheet on the accounting worksheet that we've prepared before, but now it's a little different when it comes to looking at just a sole proprietorship. So with the income statement, this is the financial statement that summarizes the profitability of a business entity for a specific period. So it's the same purpose as the income statement columns on the accounting worksheet. It's just going to be a separate financial statement now. Then the balance sheet provides complete details of assets, liabilities, and owner's equity as of a specific date. So again, that's the same purpose as the balance sheet that we created in the accounting worksheet. This one's where it gets a little different. So the statement of owner's equity is a summary of changes in the owner's equity that have occurred during a specific period of time. So there will be an assignment later on looking more at this, but basically it's a summary, just like it says. So it's a summary showing how owner's equity has been affected during that month or year or however often you prepare these. Then there's also the statement of cash flow. This is the summary of cash receipts and cash payments for a specific period, such as a month or year. So again, this is just kind of the incoming and outgoing of cash in our business. But the primary financial statements are the income statement and balance sheet. Those are the primary financial statements of a sole proprietorship. We kind of just have these other two to get a good idea of how our cash flow is going, owner's equity, how the value has been affected, but the income statement and the balance sheet give us a better idea of how the business is doing financially. Okay, basics of the income statement. So again, the income statement is a summary of the business's revenue and expenses. We know this. When we did the accounting worksheet and we transferred the balances, we only transferred the revenue and the expense account balances over into the income statement columns. And the statement presents the net income or net loss for an accounting period. We knew that. Let's look at, so these are some terms involved with the income statement. So revenue, we've said revenue before, is the increase in business assets from its profit-directed activities. So whenever we see in those transactions, we see the terms provided service or provided product, okay? We receive money for services provided. That means it's affecting our revenue account because it's the resultant increase based on our profit-directed activities. So what we did to get a profit involves our revenue accounts. Expense accounts are the source of decrease in the business assets from its profit and directed activities. So they result in negative cash flows. So this is money being spent. For example, payment of salaries or wages by a business unit. So we've dealt with those expense accounts before: salaries expense, utilities expense, materials expense, all those different expense accounts would result in cash leaving the business. Okay, net income is the difference between revenues and expenses for a specific period. So, for example, sale of goods was $10,000, expenses was $3,000, so the net income, or expenses is $7,000, so the net income is $3,000. So our sales totaled $10,000, our expenses totaled $7,000, so our net income is the difference between revenue and expenses, which is $3,000. And that's net income because our sales outdid our expenses. But when we're looking at net loss, this is the exact same setup, only our expenses exceeded our sales. So when we find the difference of $2,000 In this scenario, that would be a net loss because our expenses exceeded our sales. And net income is when our sales exceed our expenses. Net loss is the opposite. Okay, the purpose of the income statement. This is an activity statement that reports the financial performance of a company relating to revenue and expenses within a specific period. So again, that's where we talked about the month ending or the year ending in the certain date. Revenues are the result of a business transaction resulting in positive cash flow. Revenues are the result of a business transaction resulting in positive cash flow, meaning we're taking in cash. The income statement outlines any changes in the financial position of the business for a specific period of time. So again, it shows us what our business is doing financially. Are we bringing money in or are we losing money? Okay, here's some examples of what the income statement is going to look like. This is an income statement example when there is net income. So when we have a net income, this is what the income statement would look like. We list our revenues first, and you're going to see two columns on an income statement. Revenues are going to be recorded in the far right column. Expenses will be recorded in the left column. And then so you record your revenues, you record your expenses, you total your expenses, and then you find the difference between revenue and total expenses, which in this case is a net income of $500. When there is net loss, net loss is the excess of expense over income. So we have our revenue, we have our expenses, we have the total of our expenses, and then net loss because our expenses exceeded or they were more than our revenue. So we have a net loss in this situation. Okay, several people will use our income statement. We'll have internal users, so owners and employees, and then also external users, which would be like the government and customers. So owners are obviously going to be interested in knowing how the business is performing financially in order to make good management decisions. Employees are going to want to know that they're working for a business that is succeeding. They're going to be interested to know if there is net income, and then could also lead to a salary increase, or they're going to want to know, is the business that they're working for incurring net loss? Okay, so then that might be a sign that maybe they want to start looking for another job if the business is going under. So they have a right to that information. The government's going to want to know your income statement because they want to make sure they're taxing you correctly. Customers are going to want to know that your business is indeed successful. For instance, if they order something and they don't want your company to close down before they get that order. That's basically what this page is talking about. And finally, creditors, or people that loan money to your business, they're going to want to know that you're succeeding as well. Because if they're extending out loans, they want to know that they're going to get that loan paid back and that your business is succeeding. Okay, oops. Let's see, that was 12. We look at 14. Okay, so how to prepare an income statement. With the income statement, we have, just like on our worksheet, we have a heading. So the who, what, when. And for instance, in this example, the who would be Rainbow Manufacturing. The what would be an income statement. The when is the month ended March 31st. Revenue is going to be the revenue. So you're going to list the revenue accounts for that company and their account balances. So the first amount column enters the balance of the individual revenue and expense accounts. The second amount column enters total revenues and total expenses. So we use this first column to list all the individual balances, and then the second column to list the totals. So if we had several revenue columns here, like revenue accounts, we would list them all in the left column first and then total them and move that total into the right column. I think I said that differently on the previous page, but just because there is only one revenue account. And so same with this one. If there were multiple revenue accounts, we would be listing them all in this left column and recording the balance in the right column. So just like they did with these expenses. Listing the expenses in the left column, they record the total in the right column, and then they do their math here to find the total net income. Okay, make sure you check out this video on page 15. The sound doesn't come through if I play it on my end, but this just shows you how to set up an income worksheet. And this last page, make sure you check out this page as well, and this defines a lot of these terms for you. So that is the income statement in a nutshell. We will go over the assignment and look more closely at an income statement during our next class connect session.